I've got a great question for you, Kevin. You guys always, or you specifically, always talk about, your job is to make me money, right? And so if my job was to make you money, and you were going to invest in, an entity, with me, what would your view be on the concept of cash flow versus growth? So specifically, are you looking more for a company with good and consistent cash flow, but not necessarily the growth potential that another company would have, or would you be looking for someone with kind of a modest initial positive cash flow, some reasonable level of profitability, but that's just
I mean, you're basically talking you're talking about reinvesting the cash flow before you take any out. I get it. I totally get it. Here's my view of this, because I have so many companies on my books now, and so many different deals, and so many different markets, all kinds of consumer goods and services, and some financial services, and some technology companies. So let's say, I'll give you an example of one I'm having this exact dialogue with right now. I'm a 50-50 partner in it. I've put about $6 million into the deal, and now it's starting to spin cash. And so the debate I'm having with the partner is, wait a second, we've got $12 million invested between us. It's making money. Why don't we pay ourselves back a little bit before we take the next million it's going to make and expand the business? In other words, it's stable, it's got itself market share, it's built itself a brand, and now after 5 years, because I've been in the deal for 5 years, I'm in a situation where the thing is spinning cash. So I'm of the ilk that says, you don't live forever. I have this. If you know the business is growing, you should start to think of the context of 5 to 7 years to get your capital back. Doesn't mean you have to sell it. So what I'm saying to him is, look, let's do this. Let's return our capital now. Let's slow down the growth a little bit. Let's cut the growth in half to de-risk our portfolios. $6 million is a chunk of change. It takes me a lot of time to make $6 million, and I'd like to get that back. And then I'll put more growth metrics into the business, because it's got enough share in its market and it's doing very well, but now it's returning capital. So my view is, you've got to get your bait back within 5 years. That's what I want. Otherwise, it's a perpetual cash drain and you'll never get a return. Return of capital is more important than return on capital. That's my answer.
Did that answer your question, Kelley?
Spot on. Yeah, that's great. You can probably do both, right? You could have a good return on capital and excellent growth possibility.
Yeah, and you should put some numbers on that. If you're going to take capital and tie it up into a liquid asset, you want to be making 11% a year minimum. Now, in this case, I'll hopefully make more, but if I'm not making 11%, I'm taking huge risk, and I'm going into liquidity. Why am I doing that? Because I can make 6 or 7% in the market. I've got to make basically a significant amount more to tie myself up. I make these decisions every day. I listen to deals every day, and I ask myself, how much capital, how long is it tied up, when do I get it back? It's a portfolio approach. But if all you do is invest in deals that never return cash, you'll starve to death.
But my question, and what if it's your business?
Yeah.
In terms of if you're Tiege Hanley,
yeah,
and you are trying to balance, the growth with profitability, where do you put your effort?
If I were your partner, if we were 25% each, or a third each, at this point, looking at the numbers I see there, I would probably do 1/3 return of capital to the partners and 2/3 to sustain the business. In other words, you've earned the right to de-risk yourself on this business. You've done something amazing. Those are incredible numbers, and you've basically found a way to acquire customers on a profitable basis. I think you should be returning, you take every dollar that comes into cash flow, 33 cents is distributed to the partners, and the other 66 cents stays in the business. Because you've earned that right now. You have enough. And a lot of people say, no, it's all about the business. Well, I got to tell you why I think this way. I've seen, and I've been doing this for many years, in every business, poo-poo happens. You don't know what it's going to be. You have no idea. The black swan event can wipe you out. You don't know why or when. It just happens. But if you de-risk yourself by taking out a portion, maybe you make it 25%, it's 25-75. But once the company's business just is profitable on a cash flow basis, just like I talked about on mine, I want to take some off the table. And I want to redeploy it and do other things with it and de-risk my portfolio by deploying it in some other idea. I think that's what you guys should do.